I want to share with you my findings of Vanguard Wellington versus the Vanguard Dividend Growth Fund. So the Wellington is VWELX, is that right? Or VWEIX. So there's one of those two tickers. You got the Wellesley, which I think is VWINX, and the Wellington is VWEIX, I believe. Anyway, so you got the Wellington Fund, which I like a lot. It goes back to 1930. And, when I'm done my course, I'll finish out my book, You Can Retire on Wellington Fund. But then I came across, because a couple guys shared with me the Vanguard Dividend Growth Fund. I had never even, I didn't pay any attention to it just because I've been an index guy. But I like that Dividend Growth Fund a lot. It's been around since 1992. And the fact that it has reopened for investors, I think is cool. One of the benefits of Vanguard funds is that once they get too big, they do close them. Like Prime Cap's been closed forever. Apparently the Dividend Growth Fund's been closed for a long time as well. So at some point they lose assets for whatever reason, and then they say we have enough room where we can take on more assets, but at some point we're going to hit a certain threshold, we're going to close it up again, which is good. Because once you're an active managed fund, if you just have this huge growth of assets, you can't manage your portfolio the way you would when you're just starting out. And that's why I use for the example all the time, the Fidelity Magellan Fund. Peter Lynch was a runner of the Fidelity Magellan back in the late 70s, early 80s, or 70s, 80s, early 90s, before many people knew about it. But because his stellar track record, the money just flowed to him. And if you're wondering what I'm doing, I'm actually out in the parking lot waiting for my daughter to get her homecoming hair done. So I'm just sitting here with the AC on. Oh no, I'm adding CO2 to the climate. Oh. And I just added, what's this, right? Ready? Just added CO2 to the climate. CO2, I love you. Anyway. So what happened was when the Fidelity Magellan Fund got so big, they had to end up buying crappy stocks that they would not have otherwise bought. But they had so much money in there, they didn't want to turn down the money, and so then they became a middling fund. They became a closet index fund essentially. And then when Jeffrey Vinnick and what's the other guy's name, Stansky or something like that, I can't remember. There's another guy took over. They just had okay performance, nothing fancy. But they didn't do much with it just because it was so big. They had to buy not their top shelf stocks, but the second, third, and fourth stocks. And if not the fifth, because they had so much money. And then their returns basically became like a closet index. Worst kind of investment you should have is a closet index fund. That is a heavily diversified fund, like similar to the S&P 500, but they don't charge index fees. They charge 100 basis points, 150 basis points. I think Fidelity Magellan probably charged 90 basis points. Anyway, the performance lags once the fund gets too big. That's how that works. And you see this over and over and over again. And so Vanguard is very conscious of that. Once a portfolio hits a certain size, they say we're going to close it to new investment. And I think that's pretty good. So the Vanguard Dividend Growth, they reopened it, but I assure you that sucker is going to be closed at some point. Because they got some press about the fund reopening, so there's going to be certainly a flux of money going in there. And I've since invested. I think I put $25,000 in it the other day, so at least I have my stake in it. Kind of like if you had your stake in Prime Cap, they can't deny you investing more. They just say new investors aren't going to be welcome here. That's good. So anyway, the Dividend Growth Fund goes back to 1992, and it's interesting if you look at the performance of the dividend growth to the Wellington funds. Remember, the Wellington fund has got about 65 to 70% stocks, and the rest in bonds. All right, and so it's a moderately aggressive fund. The Dividend Growth Fund is 100% stocks. They even have some international, not much, but 100% in stocks. Both are actively managed. I think the Dividend Growth is also run by the good folks at Wellington. So they're both actively managed funds. Dividend Growth and 22 basis points. And Wellington's like 30 basis points for the fees. Anyway, so I'm going to there's going to be three separate instances we're going to look at performance. So we're going to look at total performance from Wellington and Dividend Growth going back to the inception of Dividend Growth. I put $100,000 into each. Obviously, I can't show you my spreadsheet. The Wellington, the Dividend Growth Fund grew to about $750,000. The Wellington grew to like 920 for the beginning of 1993 till I think I did end of 2018. 100,000 in dividend growth grew to about 750. 100,000 in Wellington grew to 920 or something like that. But it's like $170,000 difference between the two. That's significant. Now, from 2000 to 2018, the Wellington smoked the dividend growth fund as well. I don't remember the exact returns, but the Wellington did better than dividend growth fund from 2000 to 2018. Interesting though, from 2009 until 2018, though dividend growth smoked Wellington. And that was the interesting thing. So in 2008, the dividend growth fund was down 25.5. The Wellington was down 22.3. So they both had similar downside. 1994, 1999, dividend growth fund was down because now I can't remember. I think the dividend growth fund was down because the rule of thumb is when the don't fight the Fed. When the Fed's raising, you don't want bonds or stocks that have yield dividends simply because the Feds are raising. That's the old rule of thumb. Don't fight the Fed. At the end of the day, that's just short-term stuff. Don't be a sucker for that. But anyway, so 94, 99, if memory serves, the dividend growth fund had negative numbers. And I can't remember the Wellington off the top of my head, but I do know for a fact that from 2000 I got two cops pulling up. What's going on? They're coming after your old buddy Josh. But from 2000 to 2018, the dividend growth run lagged. So we got 2001. In 2000, the dividend growth fund was up 18%. All right. But in 2002, it got smoked, whereas Wellington did not. 2008, they both took it on the chin, but dividend growth fund did a little bit worse, but not anything like the S&P 500. The S&P 500 was down 37%. But the dividend growth fund was down about 25, whereas Wellington was down 22. But in 2002, the dividend growth fund got spanked. All right, so as I'm sitting here today, I say, well, the dividend growth fund underperformed the Wellington over this 25-year time frame, even though the dividend growth fund has all stocks. So the Wellington not only performed better, but performed better on a risk-adjusted scenario as well, significantly, because it has less risk because of the bonds. But what can you take away from that? And this is my issue. Remember, the yields on the 10-year treasuries back in the 90s were 5%, 5.5. So when they raised rates in 94, 99, they raised them from let's say 5 to 5.5 to 6. All right, but they've been cutting ever since. So they've been cutting essentially until they've been cutting until 2010. When they cut rates, you have a short-term jump for bonds. You do, but now that we're at the rate bottom, essentially, the bonds have nowhere to go but down or flat. That's it. So you might be looking at 2% on a freaking 10-year Treasury if you're lucky, 2.5 on a 30-year Treasury. I mean, you just don't know. We don't know what the bond rates are going to be, but we do know that at the end of the day, the gains that the Wellington Fund made from bonds probably aren't going to happen again. And see, but I don't know that. That's the issue. You're sitting there thinking, I like the idea of Wellington, but man, the bonds just don't have any upside there. And the dividend growth, while it's all stocks and more downside risk, there's more upside too. Because the Wellington, what rescued the Wellington essentially is the bonds, because the bonds gave them, safer returns that were decent, and in the late 90s and 2000s. But from then on, they haven't been. The bonds are giving you 1%, 2%, 3% respectively across the board, going back to the last 10 years. You're not going to have any difference there. So that's my concern. I'm sitting there, I'm looking at the numbers. I'm saying to myself, I want to default to the Wellington, but I can't see doing it because I can't see bonds giving you any return. I just don't see it. I had a bunch of guys say my bond was up 10% this year before the 10-year went up from 1.4 to now it's 1.8. So that's a 40 basis point increase in the 10-year bond, which means it took it on the chin, but was an 8% decline in share price if you looked at the Vanguard long-term bond fund in 2 weeks' time. That's a significant drop-off in 2 weeks' time. And so a bond, if it goes up, it's coming back down. There's no other way around it. It goes down, it's going back up. A bond we know exactly what the bond is going to give you. There's no ifs, ands, or buts there. If here's par, the bond's above par, it will go down to par. If here's par, the bond's below par, it will go up to par. So we're sitting here thinking right now you're getting 2.5%, 3% coupon. The prices are probably well above par, which means they're going to have to go down. That's a significant headwind. I don't know. So I just can't buy the Wellington. I just can't. I do not believe that the bonds are going to rescue the Wellington like they have in the past. I just don't see it, man. And I certainly could be wrong here, but dividend growth did poorly relative to Wellington for the 25 years. Dividend growth did poorly relative to Wellington from 1993 to 2010. Dividend growth smoked the Wellington from the last 10 years when the bond market essentially has been flat. And I think that's going to happen going forward. So up to you to decide. Again, the ticker for dividend growth is VDIGX. I own it. There's a disclosure. The ticker for Wellington is VWELX. VWELX is, I think, either VWELX or VWIEX. I'll let you guys figure that one out. All right, we'll see you next time.